Welcome to today's video lecture series. Today I'll be talking to you about fundamentals of accounting, and with that we'll be walking through the session on introduction to accounting. What is meant by accounting? Accounting is defined as the art and the science of recording, classifying and summarizing transactions in a business. So accounting has got two major parts. It is said to be an art, it is said to be a science. Accounting is said to be an art because presentation matters a lot in accounting. It is said to be a science because it has definite laws, it has definite principles. So that's the reason why it is said to be the art and the science. Now, why does a business really need accounts? Business needs accounts for three major reasons. Someone has to keep a systematic record of the transactions. Some point of time in the business we have to determine, is the business making profit or is it making losses? Then we have to estimate what is the financial position of the firm. Financial position of the firm is determined in terms of its assets and liabilities. So these are the three major reasons why a business would need accounting. Moving on, there are three major branches to accounting. The three branches are financial accounting, cost accounting and management accounting. Financial accounting deals with bookkeeping and preparation of final accounts. Cost accounting deals with the study of cost and how to reduce this cost. Management accounting uses accounting information to take business decisions. So like I said, once again, there are three branches of accounting. At some point of time, if you focus on becoming a chartered accountant, please remember you're specializing in financial accounting. You're learning how does a business maintain its books of accounts, how does the various types of business prepare their final accounts, etc. If you end up being a cost accountant, you will be specializing in what are the different categories of costs and how these costs can be reduced. If at all you turn out to be a management accountant by taking up courses offered by CMA, CIMA in UK, etc., please remember you're specializing in management accounting. You're learning how management accounting information can be utilized to take business decisions and to take better decisions for the business's future. Now moving on, we'll be talking more about the accounting process. Accounting process refers to the systematic process of recording, classifying and summarizing transactions in a business. There are three major steps in accounting process: recording, followed by classifying, and then finally summarizing transactions. The accounting process starts with transaction. What is a transaction? Transaction is the exchange of goods and services in return for money or money's worth. As soon as a transaction takes place in a business, someone has to keep the record. Someone has to keep the record of the transaction that has taken place. Transactions are recorded in books of accounts which are called as journals. Transactions gets recorded into journals in the chronological order, which means transactions are recorded based on the date. Following this, depending on the category of the transactions, they have to be segregated and categorized. There may be some transactions where there is outflow of money. There are some transactions where there are inflow of money. There are some transactions where your assets would be coming into the business. There are some transactions where assets would be moving out. So there are various categories of transactions in a business. Depending on the category and the type of transaction, it has to be segregated. Once the transactions are segregated from journals, it gets recorded into specialized books of accounts which are called as ledgers. Ledgers are secondary books of accounts. Following this, you have to determine what is the outcome of the transactions that are carried out by the business. Throughout the financial year, the business would be carrying out n number of transactions. But what is the net outcome? Is the business making profit or is the business running on loss? To understand this, we have to summarize transactions in a business. Now, transactions are summarized in a business by preparing what is called as final accounts. So final accounts will help us to understand, is the business making profit or is the business making loss? Now we will try and understand a little bit more about the summarizing phase of the accounting process. Summarizing phase will help us to understand what is the net outcome of all the transactions that are carried out. If you're a small business, you may be having fewer number of transactions. If you're a large business, you may be having large number of transactions. For example, IRCTC on an average every day clocks around 25 lakh transactions. So when you look at across the financial year, we want to know what is the outcome of all these transactions. There are some transactions where money is coming into the business. There are some transactions where money is going out of the business. But what is the net outcome? So for doing this, we will have to prepare, we have to summarize the transactions. Now summarizing starts off with the help of ledgers. So please remember, ledger preparation is a part of classifying phase of accounting process. But preparation of final account starts from there. At first, the business will prepare what is called as trial balance. Trial balance is the summary of all the ledgers of a business. Following this, the first final accounts that gets prepared is called as a trading account. Following trading account, we prepare what is called as profit and loss account. After profit and loss account, balance sheet gets prepared. Now, trial balance is referred to as a summary of all the ledgers in a business. So, whatever balances the ledgers has, those balances will get transferred to the trial balance. Following this, trading account gets prepared. Trading account is prepared to determine the gross profit of the firm. After trading account, we prepare profit and loss account. Profit and loss account is prepared in order to determine the net profit of the firm. Now, what's the difference between gross profit and net profit? Gross profit refers to the profit made by the business from its core activity. Net profit, the total profit of the business. So there may be some activities which are carried out by the business which may not be a part and parcel of the core activity of the business. So that's the reason why we end up determining two profits. Gross profit talks about the profit the business has made from its core activity. Net profit, the sum total of all the activities that are carried out. Balance sheet gets prepared to determine the financial position of the firm. Financial position of the firm is estimated in terms of its assets and liabilities. Now, trading account, profit and loss account together, they are called as the income statement of a firm. It is called as the income statement of a firm because it is these two statements which talks about the profitability position of the firm. It talks about, is the business really making profit or is the business making loss? So that's the reason why these two statements together are called as the income statement, and balance sheet is referred to as a positional statement because it helps you to know the financial position of the firm. Moving on, what forms the cornerstone of accounts as a subject is what is called as the accounting equation. There are two kinds of accounting systems. We have single entry and double entry, but accounting equation forms the cornerstone of the double entry system. Now, it also helps you to assess the accuracy of the books of accounts maintained by the firm. Accounting equation states that assets of a firm should be equal to the sum total of capital and its liabilities. So once again, the accounting equation states that assets of a firm should be sum total of capital and liabilities of the firm. Now let's look at these terms one by one. What is meant by capital? Capital refers to the assets which are owned by the business. It refers to the money brought in by the proprietor to start a business. Now, then we'll talk about the assets. Now, what are assets? Assets are basically resources which are owned by the business. Assets can be broadly classified into two. You have current assets and then you have fixed assets. Any asset which can be liquidated immediately, it is called as current asset. Some examples of current assets are stock, bills receivable, debtors, etc. So these are some examples of current assets. So any asset that can be liquidated immediately is called as current asset. Then we have fixed assets. Fixed assets refers to the assets which are prepared or which are owned by the business, and these would take time to liquidate. So some examples of fixed assets in a firm are land, furniture, machinery, etc. Now we'll move on to look at what are liabilities. Liabilities refers to obligations of the business. It refers to money which has to be paid back to the business. Now, whenever a business goes in for a liability, please always remember there's a cost which is associated with it. If it's loan, then the cost associated with that would be interest. So, whenever a business looks at raising an obligation, please remember there's always a cost which is associated with it. Liabilities can be broadly classified into two. We have long-term liabilities and then we have current liabilities. Current liabilities, these are obligations which have to be fulfilled immediately. Some examples of current liability are bank overdraft, bills payable, etc. Then we have long-term liabilities. These are liabilities which can be fulfilled by a business over a period of time. Now we will move on by trying to understand what is meant by accounting principles. Now, every country across the globe, they would have their own method, they would have their own ways of maintaining the books of accounts. But at some point of time, all these books of accounts has to be standardized. So that's the reason why we have what is called as accounting principles. So accounting principles are a set of guidelines, there are a set of rules, there are a set of regulations which are prescribed by the government or a statutory body in order to standardize the practices of accounting. If a principle has to be accepted as an accounting principle, there are 5 important criteria it has to be fulfilled. It must have a definite objective, there must be a purpose for having that accounting principle. Second criteria is that it should be usable in all practical situations. There are various types of business. We have sole proprietorship, we have partnership, we have company, we have cooperative society. So irrespective of the type of or the format of the company, the accounting principles should be applicable. Third criteria, it should be reliable. It is something which has to be applicable throughout the year and it can be applied at any given situation. Fourth is, it should be something feasible. It should be something which is practically applicable. Fifth criteria, it has to be comprehensive. It should not be exhaustive. It should not be too detailed, making it too difficult and comprehensive for us to understand. Now, accounting principles can be broadly classified into 2. We have what is called as accounting concepts, and then we have accounting conventions. Now, accounting concepts, it's referred to as a set of assumptions which are given to the accountant to maintain books of accounts, namely journals and ledgers. There are around 10 accepted accounting concepts, and now we will look at what are the accounting conventions. Now, accounting conventions, these are a set of best practices which are given to the accountant to prepare books of accounts. So please remember, accounting concepts are assumptions and accounting conventions are a set of best practices. Now, off lately, what has got a lot of attention, especially in international context in terms of accounting, is what is referred to as International Financial Reporting Standards, or what is referred to as IFRS. Now, every country across the globe, they have been prescribing their own accounting principles. In today's business scenario context, businesses have gone global. So, for example, we have ICICI Bank, which has presence in Bahrain, Canada, United Kingdom, etc. Now, it becomes practically difficult for the companies to have a global presence because every country has got their own unique accounting principles. To avoid all these difficulties, what has happened is IASB, or which is referred to as the International Accounting Standards Board, has prescribed what is called as IFRS in order to keep all the accounting principles across the globe uniform. So with that note, we've come to the end of today's session. Thank you.